Hi, everyone. Thanks for joining today. Today I have my CPA Thomas Jones over here, and also his colleague Will Park join us today. So a few housekeeping things. Most of you guys are already familiar with the Q&A sessions, which is like the bubble, like the chat marks on the bottom of your screen or so, is used for asking question and answers. I'm sure like any sessions with CPAs, we always have tons of questions. So feel free to ask them and I'll stop in certain areas to kind of get them addressed over here. For chat box, it's hard to kind of monitor. So if you have other comments and etc., just put in the chat box, but Q&A for questions. If you really can't figure it out, just put it in the chat. So I'm really excited today to have Thomas join me. Thomas has been my CPA for about 2 or 3 years now. Previous to that, I've worked with other CPAs, and you guys know me. I always do a lot of research in who do I use as my inner circle experts to help me. And Thomas, we met at a social event, and after a few questions, I lobbed some difficult questions his way, and he always had a really sound answers for it. And for the ones that he didn't, he will send me a whole paragraph, like literally a book on all the answers for that. And also kind of make fun of Thomas a little bit. He's very young. He looks like he's very young, but he's actually a lot older than he looked like. So again, I'm really very excited to work with Thomas over the year and then kind of grow with him in this aspect. So Thomas, welcome today.
Thanks, Lisa. Are you able to hear me all right?
Yes, hear you great. Yeah.
Perfect.
So today we want to kind of get into the CARES Act. I think we got a lot of questions asked about that. So we cover some of the PPP issues that people have, but also like from the tax implications, right? And last week we did talk about retirement plan, Thomas. And that's to do with, hey, you can take out your money like earlier, without penalty, if it's subject to COVID-19 hardship, and also you can take out a loan, etc. So some of these nuances. So Thomas is going to touch some of that too. But last but not least is a few topics that we get time to do it. I got asked this question all the time, which is like, hey, what does it mean to be a real estate professional? And so how do you leverage this to kind of maximize your depreciation? So Thomas is going to be able to kind of dive into that a little bit more. So I'm going to shut up now and let Thomas to kind of talk about through the session. Again, the slides are just here for guidance. If you have any question pops in your mind, just put in the Q&A. We'd love to kind of answer them. All right, Thomas, is all yours.
Thanks, Lisa. And to give a brief introduction, so I'm one of many CPAs who work at Sweeney Conrad. We're a mid-sized firm in the Bellevue, Seattle area in Washington State. And we're a generalist firm, so we don't just do work with real estate, but that makes up a big part of the work that I work with. I work with a lot of real estate professionals, investors, small business owners. A lot of my work is with operating businesses, working with those owners and those pass-throughs and their personal taxes, and kind of doing a holistic planning of how do we minimize their taxes and keep them on the right side of the tax law. So kind of to jump into today's topic, I thought I would kind of just give an overview of some of the coronavirus legislation that's come out so far. So there's at least been 4 different acts that have come through. The first one, phase 1, was about getting R&D out to develop a vaccine. It was to sponsor a lot of public health departments and get medical supplies out there. The phase 2 was the Family's First Coronavirus Response Act, and that was to expand the paid family medical leave that was already out there to cover certain areas that were otherwise missing, and then also created the emergency paid sick leave. It funded testing, it expanded unemployment for certain situations, and then it also, among other things, also made that COVID-19 treatment is free to individuals. And then the third phase, and the biggest phase that we're going to focus on a little bit more today, that's got most of the publicity and the media, has been the CARES Act, which has everything to do with healthcare provisions to combat COVID-19, a lot of funding the states in universities, and as we know, a lot of attention has gone to the PPP loans, the Paycheck Protection Program loans, and the emergency disaster loans, stimulus checks, tax breaks, retirement plans, like Naomi covered last week, and more. And then after the CARES Act, the PPP loans and the funding for a lot of that actually ran up really quick. And so Congress passed a phase 3.5 called the Coronavirus Interim Relief Package. And that was pretty much mostly just to replenish the funding for those PPP loans and the disaster loans. And there's currently a phase 4 that's being discussed, and people are calling it the CARES Act 2. And there's been talks about that might cover everything from continuing to issue stimulus checks to individuals that will probably, there's a big debate on whether to finance state and local governments even more. I've seen proposals for not just delaying or deferring payroll taxes for businesses, but even just eliminating them temporarily, or even creating a negative payroll tax, kind of like a payroll tax credit, and expanding that so that so that employers are able to kind of pass on those savings to their employees. So there's a lot of things, even including voting and environment, that are being debated in the CARES Act too. But the one thing that there is consensus on right now in the Senate is that they need to pause and take a look and see how are these first 3 phases of the coronavirus legislation that's already gone through. How is that impacting the economy? Is it working? Do we need to just wait things out and then kind of try to fix the economy more with a phase 4 CARES Act 2 package? So last week I was actually thinking that this might move pretty quickly, but now I'm kind of thinking, based on what I'm seeing, that this might take a little bit longer before we see CARES Act 2. And I'm not seeing as much discussion around tax changes or tax reform like there was with the CARES Act. So on this next slide is a little bit more detailed on some of the things I'll cover for the CARES Act. I think we're all familiar with the 2020 recovery rebates for individuals, or the stimulus checks. And if you haven't gotten yours already, or if you have questions, I included a URL there for the IRS link. And if you go there, you can both check the status of your payment, and there's also an FAQ page. And if you haven't gotten your check yet, my general answer has actually been probably to wait, because the IRS gets continually updating their FAQs. They're still getting a lot of information. They know there's a lot of kinks they need to work out. And so waiting might be probably the only thing you can do. They might have your information already. You might already, I have clients right now, for example, who I know that they qualify. I know that the IRS has the direct deposit information and all their 2018, 2019 tax return information. So I know that there's nothing else that we are aware of now that they need to do. But also something to keep in mind, as much as I think it's important that people get their stimulus checks soon, I think that at some point, one time or another, we will get those checks, because these advance refund checks, the IRS is going to be issuing them all the way up until the end of the year. And then even after that, we're expecting kind of similar to in 2008, 2009, when there was similar stimulus checks issued. We're expecting that there'll probably be a reconciliation on the 2020 tax return. So people who kind of fall through the cracks, or maybe there's really nuanced situations, I would expect that additional guidance will be issued by then. And then that'll be something that if you never got that payment, then on the 2020 tax return at the latest, I would imagine that you would get that payment applied to your 2020 taxes. So I know there's a lot of questions around there. I'd point you to the IRS website, and their FAQs on that website actually are pretty extensive. The CARES Act also covered the employee retention credit, the deferral and delaying of payment of employer payroll taxes, and then certain modifications of the tax code, which are temporary, including the net operating losses, meaning starting with the Tax Cuts and Jobs Act, if there was a net operating loss, or a loss that completely wiped out your income, that loss, instead of being able to be carried back as in the past, the Tax Cuts and Jobs Act said you can only carry that forward. So the CARES Act temporarily changes that, so you could actually carry it back up to 5 years. And we're still waiting on certain details, whether that means you have to start back with the 5th year or whether you can go back to the last year. And something else, there could be a benefit starting with the 5th year, because 5 years ago, we were also, if you're in the top tax bracket, your tax rate was at 39.6%. So you're at a higher tax bracket technically than you were with in 2018. One of the other changes was the suspension of the excess business loss limitation. That limitation was there for if business owners had significant losses from their business, they could only take a certain amount on the current year taxes. The rest had to be carried forward. And so for 2020 and also for 2018 and 2019, that loss limitation has been suspended, so that way you can take the full amount of your loss. And that would also lead to a larger net operating loss that you could carry back. So we have a handful of clients, for example, where they did have significant losses in 2018. And so this will be allowing them to take the full amount of their loss. And then we're also going to do a carryback to apply it to earlier years. And something to note too, that 2018 loss carryback claim, that's, I forget the specific details, but I think that's available until June 30th. And so if you did have a 2018 loss that was significant, definitely sync up with your CPA sooner than later, so that way you're not missing that June 30th deadline to file the 2018 loss carryback claim. There's a possibility that might be extended, that due date might be extended, but that's what we're working off right now, is that June 30th deadline. There was also modification in the CARES Act for the limitation of business interest. I think that's gotten a little bit of attention, but keep in mind that it's called the Section 163J business interest limitation, meaning the amount of interest expense that a business could deduct is limited on certain factors. And that's really applicable to large businesses or even mid-sized businesses. But small businesses, as defined by, I think it's 25 or 50 million revenue a year, and that's an average over a certain number of years. If you're under that revenue threshold, which most of my clients are small businesses, they're pretty either below that limit or close to that limit, but still below it. So that interest limitation wouldn't really apply to you. And then something else that's gotten some attention, but this doesn't apply to most residential rental real estate, has been the technical amendment correction regarding qualified improvement property. When the Tax Cuts and Jobs Act was drafted, late at night at the margins, they wrote down that improvements to qualified improvements to property, which really had to do with commercial real estate or retail property, for example, like a shopping center or a business that had leasehold improvements they were making to the space that they were improving and leasing out. That was intended to be 15-year property and eligible for bonus depreciation. And when it came through on the Tax Cuts and Jobs Act, the final version that was passed actually made it 39-year property, which meant that it was not eligible for bonus depreciation. So that's been corrected. Again, that doesn't really apply for residential or multifamily property, but for those with businesses and that made significant improvements to the space that they're leasing or have commercial or retail property, that could be something worth looking at the 2018 or 2019 tax return, seeing, can we amend those and carry that loss back if it was a significant loss, or just keeping in mind that moving forward, that's all going to be 15-year property and not the 39-year property. So
I have a few questions here, Thomas.
Sure.
I think this is like any tax update, it's very high level. Like I think going through the acts and etc., how does that actually translate into our current situation? So I've got a couple questions I'm going to ask on behalf of our listeners over here to kind of tie it with scenarios. So like the first question I had was, you already know I procrastinated on my tax filing. So I haven't filed my last year's return yet. We're working on that. So part of it is the stimulus check. my scenario in this case was, hey, in 2018, I had a full-time job. So a lot of my real estate credits cannot be applied to 2018, right? As such, if the Congress is going to use, my IRS is going to use my 2018 return to assess the stimulus check applicability, I wouldn't qualify. So then you're saying basically, don't worry, we're going to file our tax return here soon. But this amount of refund will be coming your way most likely. The latest is maybe as a credit on 2020 tax return. Am I hearing that correct?
Right. Yeah. And I think, again, the first plan should be to, if, for example, in that scenario for 2018, if you didn't qualify, but now 2019, you worked half the year and had other pass-through losses, it makes sense. I would still, again, plan on filing 2019 soon, so that way you could qualify for the advance.
Yeah, we're working on that. Yes. So definitely file 2019, obviously, as soon as you can, just so in case of if CARES Act 2, there's some content material rumors that I heard is the stimulus check could be coming, keep on going. So at least you're kind of getting that now versus like it maybe having to wait until later. But that's kind of reassuring for me because, hey, even though I feel like I missed out on this, but hey, we're going to file the 2019 and maybe this will catch up. And the other question I had was around excess business loss limitation or the net operating losses. So again, using my scenario as a case over here, where in 2018, I have a W-2 job, I didn't really qualify for all these great negative depreciation K1s that I'm getting from my passive investment or from my active investment in real estate, right? So in 2019, I got even more, but because I'm a real estate professional in 2019, I was able to qualify for them. We'll kind of get into that later. So there is still business losses. Could some of these get applied in 2018? If so, like, how does that work? Does any of these rules over here kind of allows me to kind of, in my situation, take advantage of it by amending past year's returns and etc.?
Yeah, so, and I'll cover that a little bit in some planning suggestions later, but the principle is if you have losses in 2020, and let me clarify too, these aren't just some losses from a business and you have other income to offset it. This would be a loss, net losses that completely wipe out your income on your personal tax return. Right. And you still have more losses after that. Then those net operating losses, those could be carried back. The part that I'm not sure yet is I'm still waiting to see guidance that specifies whether that loss gets carried back first to, if that was a 2020 loss, first to 2019 and then 2018. Usually in the past, when you had a net operating loss, the rule was you had to carry it back to the oldest year first. So that would be going back to 2015. Then anything remaining would go to 2016, 17, 18, 19. So it would carry forward after you first carried it back to the earliest year. But there's definitely, depending on whose situation we're talking about, 2018 or 2019 might have had the higher tax bracket or higher income. And so that's why that 5-year carry back election, I'm curious whether you can elect to carry back just 1 or just 2 years. And so that's some details that I'm not sure of yet.
Perfect. So for our listener over here, because some of you guys I'm already familiar with, if you're kind of listening, that is actually a big, huge point, because some of you may had a big, loss last year because you invest in syndications or doing multifamilies and all that sort of stuff, doing the accelerated depreciations. That could potentially be a conversation you need to have with your CPA. And if you're a real estate professional for all these years follow up, certainly something to potentially look into, right? Great, awesome. I do have a question over here. I'm not ignoring the question. I just want to answer back to that. It's related with PPP and EIDL. And I know that our session is coming up with the next slides on PPP and EIDL. So we're going to address that during that session. Thomas, go ahead.
Yeah, in this next slide, kind of just talks about that net operating loss and excess loss limitation. I put in a couple snippets of a 2019 tax forms just to point out, because some people had questions. I've had other clients who've had questions. Oh, had significant passive losses, but passive losses weren't going to create net operating losses. And so for most people, if we look at Schedule 1, that's where you'll see your net business losses on line 3, or your net S corp or partnership, or farm income losses on line 5 and 6. So those are the kinds of losses that, if you're just taking a quick look at your own tax return, those are the kinds of losses on 2019 Schedule 1 that would result in, on the 1040 for 2019, that's line 8B, that would potentially result in a negative adjusted gross income and a zero taxable income. That's the kind of situation that you might have a net operating loss, and that could be elected to be carried back. But I would, if you have questions, talk with your CPA. I also included a URL to the IRS that has some additional FAQs that they answered about the NOL changes.
Yeah, I'm just gonna zoom in a little bit on my, I don't know if you're kind of seeing that or not, but like these tax forms are tiny. I think it's a pre-requirement of CPA needs to have good eyesight because all these fonts are super tiny, but just want to kind of zoom in a little bit so that you can kind of see the parts over here that we're kind of talking about. So in your opinion, and Thomas, I think real estate loss, like depreciation loss, would be counted towards this. I know it's a pretty basic question. Just want to kind of clarify that, right?
Yeah. Losses from real estate generally are passive losses and would not result in a net operating loss. One of those exceptions would be if a real estate professional was materially participating in that activity. Another example that could lead to a loss that could create a net operating loss is if the rental activity is being used in a business. So I've got a client, for example, who they have the building that their business rents is in another entity, but they own both entities 100%. We consolidate them for tax purposes. And so that's another situation where if the building is used by your business, it might create a net operating loss, but that's more of a business loss. So the general rule of thumb is real estate losses are passive. That's not going to create a net operating loss unless you have one of those exceptions.
Gotcha. Okay, that's good, because it kind of segues into our next couple segments where we kind of really going to dive into this a little bit more deep. Great. Now we'll kind of move on to the PPP parts. Again, if you have any question, please let us know. Okay. Yeah, and then yes, there's another question about real estate professional. We're going to address that in the next session where we do address that, because we did have a plant segment on that. Perfect. Okay, PPP loans.
So I'm not going to go too much into how to qualify and determine the PPP loan amount. By now, at least for most of my clients, they've already submitted their PPP loan applications. And I would say usually you should work with your banker. I know that there's been a lot of differences in what bankers have been saying on some of the finer points, and I don't really have any better answer than just to refer to the SBA guidance. But
so we did have a session on this with Paul Long, like previous before. So if you missed that session, just email me on the link. If this is for the viewer over here. And also, like, I found like working with small community bank has been really helpful in terms of their guidance and response rates to you versus Chase or Wells Fargo. And that's kind of just what I've been observed along the PPP loans application perspective. So Thomas, go ahead. Yeah.
So one of the more common questions they're getting right now is, now that they're waiting or getting their PPP loans funded, what are the approved uses for the PPP loan? And I found out looking at some of the SBA guidance, and I don't know how long ago this came out, and there's still, I think, additional guidance that we're waiting on, but the best guidance is going to come from, and I put the URL in there, this SBA memo. And one of the things that they pointed out that I'm going to be emphasizing to clients when this question comes up is that PPP funds are supposed to be used for authorized purposes. And if you don't have any of these specific uses for the loan, you should plan to repay those amounts. And so I've heard of some questions, and I know that I've talked with clients in the past where before I've looked at this guidance, that if you had a loan, hey, it's a great loan. If you didn't have payroll costs or any of these approved uses, then why don't you just use it for something else? But at this point, because of the guidance, it says that if you knowingly use the funds for unauthorized purposes, you could be subject to additional charges, including fraud. So we don't want to commit any fraud here. But just to clarify, like that, you really want to make sure that what you do use the PPP loan for is an approved use. And that would include payroll costs, health insurance premiums, mortgage interest, rents, utility payments. I know there's some uncertainty on whether, for example, does internet qualify as a utility payment, or a phone payment, does that qualify as a utility? I haven't seen the specific guidance on that. Maybe I just haven't seen it myself. Interest payments on debt prior to February 15th. So if you had an SBA loan for acquiring a business, then you can continue to pay that, and the interest payment, at least that part was part of the PPP loan approved use. One of the things I would highly recommend if you're uncertain if you have enough of those first costs, because payroll costs, that's really what this Paycheck Protection Program loan is for, is the payroll costs. If you don't have enough of these other costs, I would suggest looking into, this memo says you can also use it for other allowable SBA Section 7A uses. I'm not a banker, I'm not a lender, so I don't really know what those details are. But if you do look that up, it looks like there could be some other approved uses beyond what I'm listing here. And then another common question I've gotten that I did find the answer for is also in this SBA memo. Independent contractor, so payments you make to a 1099 contractor do not count as employees for the PPP loan forgiveness. I didn't find specific guidance on whether you could use the loan or not to pay an independent contractor at all, but at least for the forgiveness portion, which we'll cover in a second, that the payments to those 1099 contractors don't count for determining payments to employees.
So we do have some questions over here coming in on the PPP, and I want to make sure that we actually address them. And can you guys still see my screen? Sorry, I'm gonna just try to make sure that you can still see it. Yes. Raise your hand if you can still see it. Perfect, thank you. Okay, so the question over here is, I'm applying for EIDL and PPP, received the EIDL and approval for PPP. Congratulations, some of us cannot. Do you think it's a good idea to stagger my paycheck payments?
I'm not quite sure what staggering paycheck payments means. I mean, payroll is kind of naturally staggered, like every 2 weeks, for example, for a lot of employers. And that kind of leads into the PPP loan forgiveness, which I'll cover in a second. Because you do want to make sure that if you have payroll costs, you want to have that within the 8 weeks that you've received the PPP loan forgiveness. And that will help your loan forgiveness calculation.
Gotcha. Okay.
Should I jump into that loan forgiveness, or is there another?
Yeah, I think there's a couple more questions. We'll address that. I'm not going to mark that question as done. And then so her question was, I have a USP store for my business mailing address. Can this be qualified as rent or utility payments?
I don't think I would qualify. I mean, that's like a lockbox rental, and I think that's similar to that. And that's one of those things I'm not sure of. I think that if it really does come down to that level of detail, you should definitely be working with your CPA already to make sure that you really do have justification for making those payments. And I'll cover in another slide one of the suggestions I have for kind of tracking those things.
And then again, like all tax issue, Mercy, over here is, it's all not black and white. So I think Thomas is usually a little conservative, but when he tells me, especially in public places, what I can use, what I cannot. Um, I think it all comes to justification, whether or not these are kind of like fits into the rental or utility. I think utility will be kind of hard to qualify because there's probably specific requirements around utility. The rental part is also based on the rules. So I would encourage you to kind of check it with your CPA and see like how you actually rent them, etc. Could that be qualified there? Now I'm gonna go back to one more slide over here. Like the mortgage, rent, and utility. I think, Thomas, if I'm correct, the payroll protection program is really meant to pay for payrolls, right?
Correct. Right.
And as such, there's a forgivable part. I think once you receive the fund, it's very important that how you apply this will make it forgivable. The other day I was kind of talking with someone about that, and thank you for reminding me it. It's 75% of the PPP loan must be used for payroll. It may mean that only 25% of the fund can be used for rent, mortgages, utility, and other take. Is that kind of what your take is?
So actually, if we go to that next slide, I'm going to cover that right now.
Perfect.
I've got 2 slides on this. So just explain the calculation, because the loan forgiveness is determined based on 3 main variables. And that is, the first one, the extent that employees are maintained or rehired. And I know that I've had clients express that that's actually an issue right now, where they've offered to rehire and bring back some of their employees, and some of their employees are saying, I'm going to stay on the unemployment.
Right, because the extra $600 per week when they can qualify for that, right?
Yep. And so some employers are kind of in this mad rush. Well, I can't rehire those same employees. Can I at least get some kind of employee in there, like even if it's a temporary employee? And it seems like that actually would qualify. And then it's also based on to the extent that wages are maintained and you're not paying people less. And then third, how were the loan proceeds used? And so in the calculation, it's the average full-time equivalent employees during an 8-week period after you receive those loans. So if you get those loans based on May 1st, then you've got your 8 weeks starting right there. So you want to make sure that by that point, or if you haven't received the loan yet, that you've brought your employees back. If you have employees who for one reason or another aren't able to come back, then definitely look into, can you get in, can you fill those spots with a new hire or a temporary employee? Because determining that full-time equivalent for this 8-week period is a pretty big factor. And the denominator in that factor is going to be the average full-time equivalent employees from the same time period, May 15th to June 30th last year. And then there's also exceptions in the calculation. If, for example, you weren't in business then, but you were in business, your new business now, after June 30th last year, there's different ways to calculate that variable. And then you take that variable, you multiply it by the amount spent on payroll costs, mortgage, interest, rent, utilities, etc. And then you multiply that by the amount in reduction in wages. So I haven't heard that being a concern for employers, but if there was a reduction in what you did pay, then that could also impact the amount of forgiveness you're receiving. And I put a little snippet here also that came from just Wikipedia itself. Actually, I had a pretty good summary of how this forgiveness works. And it says, in the case of a sole proprietor, independent contractor, or self-employed person, the owner compensation replacement is also eligible for forgiveness up to $15,000 roughly, or 15.38%, which again maxes out at a net income of $100,000. And so that forgiveness amount would include the amount accrued and spent on mortgage interest, business rent, and business utilities during the first 8 weeks. And so I think that there's not, there's still some gray area. I could see that you can interpret it one way or another. And so I think that the key for right now is making sure that you're using the loan on approved uses, and that you're bringing your employees back. You're not decreasing the wages, that you have enough full-time equivalent employees, that those other variables, what you can control right now is being done. And then on the next slide, if you go to the next slide, this is another big question I've had from a lot of clients is, what if the PPP was only used on other approved uses other than payroll costs? So this is interesting, and I think that the way I interpret this, and I'll show you my algebra here, the way I interpret it is not the way I'm hearing a lot of bankers and other advisors say it. So I'm hoping that I'm wrong and they're right, but this is the way I read it. So the SBA memo said at least 75% of the PPP loan proceeds shall be used for payroll costs. So if we have, and then they also say not more than 25% of the loan forgiveness amount may be attributable to non-payroll costs. So if we have this little formula here, other non-payroll costs plus payroll costs equals the forgiveness amount, and then you plug in for other uses that 25% of the forgiveness amount, you work out the equation you end up with is the payroll costs divided by 0.75 or 75% equals the forgiveness amount. Now, if you don't have any payroll costs, the way I interpret it based on the language here, if my algebra is correct, is if you don't have any payroll costs, even if you used the PPP loan for other approved uses, you still don't get any forgiveness because there was no payroll costs. That's the way I'm interpreting this now. Again, I'm hoping I'm wrong, because I'm getting a lot of people who are saying the advice they got from their banker was, if you got $100,000 for a PPP loan, 25,000 of that could be used for these other approved uses other than payroll costs. But that's not 100% true, I think.
Yeah. And then in terms of payroll costs, do you also consider 1099s as a part of the payroll?
No, and that goes back to a couple slides earlier. I said that independent contractors do not count as employees for the loan forgiveness.
Gotcha. Okay. So if we got, kind of dovetail into questions that we've got, a person doesn't have business entity at all. They report their tax on their personal tax return, I'm guessing through Schedule E. They had a few units with families, and they try to understand if they qualify PPP loan. They don't have any employees, but would like to use it to pay mortgage or other tenants if tenants are not be able to pay. So they've got a checklist from their local bank, and it's asking documents they have no knowledge of. Okay, I think I try to deduce a question over there. The question is probably, hey, is PPP, could I get PPP? There's a 2 section of the question over here, because by now some of the guys already got their PPP in idle, right? So, and by the way, does the rule also apply to idle loan?
These rules are specific to the PPP loan.
PPP. Gotcha.
The nice thing about the idle, the emergency disaster loan, is that's an existing SBA program under SBA 7A. And so I think that there's going to be more defined guidelines versus this PPP is kind of the wild, wild west.
Yeah. Yeah. So the idle loans also, you can get up to 1,000, but a couple things just from a couple weeks ago, people has already applied for it from what I heard. They're going to pull your credit. So that's something to kind of consider if you're going through a refis and etc. And also the new guidance was you only get up to $1,000 or so, even though it says it's up to 10,000, but for each employee, including yourself, you only get $1,000 per employee. So as a sole proprietary member, people got their credit pulled, but only got $1,000. So hence I heard about these complaints about it. So it's something that you should evaluate. I would say to answer this person's question, the best is to kind of check into idle, although I think the funds are already probably run out at this point. But if you're working with a local bank on how they qualify, I think I got asked about Schedule C, which is really the areas where you get paid on, and also your payroll to kind of prove the self-employment. If it's on Schedule E, it's kind of not counted towards that. Okay, so I think there's a couple other questions. Hopefully that answers the question over there. There's a couple other questions over here. PPP usage Oh, yeah, we already kind of covered that the UPS stores, et cetera. So the answer is like maybe you want to check back with your CPA who's doing your tax. If it happens to be Thomas, he's going to dig into this a little bit deeper for you. Yeah, so okay, is there a limitation on how the funds are used at taking from 401k CARES Act? I think that's a different sessions, right? We're going to cover that later over here.
Right.
We do get a lot of questions over here. So Thomas, how will we know that whether or not your formula over here is correct or not? Can we do certain follow-ups with, because I mean, like any IRS rules, it's all up to interpretation with the CPA. You may interpret it one way and someone else may be different ways. And we really don't know until like you file a tax return, you know, next year, and the IRS is either gonna come after you or not come after you. So how will we kind of know more as a follow-up to here? Because to me, you know, this seems to be a very big difference in the audience sectors that we have. Yeah.
So the PPP loan forgiveness after those 8 weeks, or I've heard that I think after that 60 days or 8-week period, you can actually apply for the loan forgiveness right away. I haven't seen the loan forgiveness application, but just like when the CARES Act came out, there was a lot of debate on, well, how do we determine the formula for how much I could qualify? And once the SBA provided that form, that shows the formula on there, and then there's just some of the up for interpretation of what to include on the inputs. And so this formula, at least once the SBA provides the application and we see the form, that will have the formula for whether if you have no payroll costs, do you get any forgiveness at all, or whether I'm wrong, which and then once you see the formula, then it'll be up to working with your banker or your CPA to determine, you know, what are those qualified costs, and do you have all the documentation that you need.
Gotcha.
To
And when do you think we might be expecting that? Because I'm thinking about potentially maybe do a future update with our audience over here, just as a follow-up. I mean, that's kind of like looking into a crystal ball, I'm sure, given that, you know, it's all matter of IRS and the schedule that they work with.
So there's two things I'm thinking of. I mean, the 60 days at the earliest, if people are getting funded, and at the end of April or early May, we might see the loan application, the forgiveness application, come out for the end of June. I think that might be the earliest. And I don't remember off the top of my head, but I think also the loan payments for this PPP loan, even if you didn't get any forgiveness, I thought that they're deferred for 6 months. I could be wrong, but whenever that statutory deferral period ends, I'm sure before then they would have some kind of forgiveness application out, so people know whether they need to make a loan payment or it's been forgiven.
So it's a good thing people got their PPP based on kind of what I summarized over here. If I was you, then I would have potentially leveraged these PPP, use them for what I needed to use, but then just be prepared to pay back a certain amount. So what happens if I did use, you know, let's say more than 25% on paying my mortgages? Can I pay that back later? Would that disqualify me to potentially the other 75% for my payroll, right? Because then otherwise my advice would be just like, hey, use whatever that you needed to use right now and pay back the amount that qualifies you to have the loan forgiveness part. Is that how you would kind of implement it?
Yeah. So I would look at it. There's two numbers that you're looking at after you've gotten your loan. Well, you first want to account for what are all the approved uses that you've spent it on. So let's say you had 100,000 and there's 80,000 of rent, utility, and a little bit of payroll costs and health insurance premiums. So you have 80,000 that was used on approved uses, and then let's say you did your loan forgiveness application and 40,000 was forgiven. So the 20,000 that was not used on approved loan uses, expect to repay that back. For that, the 40,000 was forgiven, you're good there, but that 40,000, the difference between 40 and 80,000 that wasn't forgiven, that would be your remaining loan balance that you would expect to pay loan payments on.
Okay, so I shouldn't be afraid of not using it and wait for the guideline and then start using it or back pay or something like that.
Hmm.
Okay,
Right. That's how I understand it.
gotcha. Okay, I think that's all the questions for PPPs. Let me just double check over here. Oh, we have more questions. Does taking a PPP loan put you into default with current agency loans or future agency loans or any loan? Let me just expand that question a little bit more because I think agency loans, they will pull your credits and etc. Unless if you're in like kind of default position, you can apply for more. I think so. Obviously, that's an interesting question. But also, a lot of people are doing residential refis as well. That they will look into your personal finance even a little bit more. So, what taking a PPP loan kind of put you in adversity when you apply for new loans?
What was that last part of the question?
So by taking the PPP loan, would you put into a default with current loans? I don't think it would be put in current loan or future loans
Right.
more so is the consideration. Does that show up on the credit checks? I guess it's more so.
So the PPP loan, as I've read, is not personally guaranteed. So that's something else to consider if, for example, you have an entity, an LLC or a corp, and that entity gets the PPP loan, and let's say that it was all used on 100% approved uses, but none of it was forgiven, but business still didn't go well, and you had to liquidate and close everything. So basically, your business declared bankruptcy because you, as the business owner, are not personally guaranteeing the PPP loan. You could walk away from it, as I understand.
Okay, so it's a
So
no
that's
recourse loan. Yeah.
right. And
Okay.
because it's not personally guaranteed, I don't think that they should be checking your credit. There was a lot of, I've seen a couple articles online of um, talking about bankers who are charging for these PPP application fees or for
Mm,
checking your credit to see if you really do qualify or not. And then in that CARES Act, excuse me, in phase 3.5, that legislation that came out, there was some clarification there as they were refunding the adding more funds to the PPP loans. I think there was some clarification there that they said that these bankers just need to use the standard SBA guidelines. They can't do anything extra. They shouldn't be pulling your credit, I think.
gotcha.
And then they should be charging extra fees. So I'm guessing that it wouldn't cause you to go default into something else. And it is an approved
Mhm.
use to at least make interest payments on other loans.
Gotcha, gotcha. So unlike idle, because I can attest that idle, they do pull your credit. So at least that question will come up if you do apply for a residential loan. I think this would be a matter. I think it just kind of addressed the questions of it a little bit with the agency loans and et cetera, because that's a separate question for the lender for agency loan. I do talk to them pretty often. You know, the agency loan, they do pull credits on your thing, but their requirements are usually pretty low. It's like a 650 credit scores and et cetera. So usually the PPP loan should not pull your extra credit. So as if when they pull your credit is if like you don't have that loan. That's kind of how these things kind of show up. Okay, so answer that question there. Okay, I think we're ready to move on to the next session. I know with the CPA sessions, we always run over on our time, but want to kind of quickly address the other topics over here too. Yeah.
And I'm going to take 20 seconds to cover the previous slide, which was I'd suggest for the accounting part of your PPP loan, you set up I would suggest creating like a dedicated checking account. That's where the PPP loan should be funded, or if you just barely got it, move it over to there, and then keep a file of any documentation for any payment you have. I don't think I wouldn't advise a client to change the ACA payments to this PPP account just for payroll, so it's coming from that specific account. I would imagine you could probably look at that account and then reimburse your main business checking account for those payments. And so I would suggest use a dedicated checking account for the PPP loan, keep a file of documentation for everything that you are using it for. And then also a heads up, IRS came out with guidance that what you do use your PPP loan for, and to the extent you get forgiveness, you won't be able to take a deduction for that on your personal taxes. And so that can affect you as early as July 15th when you're doing your estimated taxes. if you had a large PPP loan forgiveness and now you're doing an estimated tax calculation for July 15th, your net taxable income could be higher than what your net profit shows on your P&L. You need to add back the loan forgiveness amount, basically.
Gotcha. Okay, so that's a good because IRS are very smart people when they work, right? So one way or the other, they get it back on that. So that's that. Thank you so much for that note over there. Okay, so planning ideas. We did have. I was wondering if you can kind of take a moment to address some of the question on the 401k Act, CARES Act, because last week had Naomi come in and talk about 401k. So there's a question on that. Is there a limit on how the funds are used? They're taken from 401k CARES Act distribution.
Yeah, let me just double check that really quick. Just pulling up the research I had earlier. And while I'm pulling that up, is there another question I can answer in the meantime?
This kind of goes into the real estate professional. Upon filing tax, do I need to provide my activity log? I think that's a pretty straightforward question, even though it's not on the section that's coming up. I think we can kind of answer that very directly.
Yeah, the activity log, I think that everyone who's trying to qualify as a real estate professional, keeping track of your hours is extremely important. And the more detailed, the better. And keeping a contemporaneous log is best. So I wouldn't suggest going back 2 or 3 years if an audit came up and saying, oh, I'm recreating my time. That might work, but it's not going to be as accurate. But you don't need to provide it to the IRS unless they're requesting it under an audit or examination. So you don't need to submit it with your tax return. I think, and sometimes I request that from clients. Sometimes like in the first year, just to get a sense, are they recording the information correctly? Is there anything else I want to see as detail-wise? But for the most important part is that you should have it. The IRS doesn't need it when you're submitting your tax return.
But maybe a good idea, if you do log them, to send it to your CPA to take a quick look at it before you log a whole year of activity, in case if they want to adjust it or ask some more detailed questions about. Right. Great.
Right. So the question earlier was about the use of the 401k loans, like up to the 100,000. Was that the question?
Yes.
So I'm not seeing any. At the research I pulled before, I'm not seeing anything that specifically talks about how those 401k loans proceeds are used. So long as you meet the requirements that you're an affected person, and you take out the 401k loan. The 401k loans, those aren't necessarily, the guidance and the rules have been there for a really long time. So it's still going to be an actual 401k loan. You still need to pay that back. There's going to be a certain interest rate that you have to pay with those loan payments back. And if you don't make those payments, I know there's a certain, you don't have to make payments for this first 180 days or so.
Yeah.
But after that initial deferral period, you need to make payments. And if you don't, then you're in default of your 401k loan, and that's treated as a distribution. If you're younger than 59 and a half, then that's an early distribution plus the 10% penalty. So I would still treat it like a regular 401k loan. You can use it for whatever you need to, but still, so long as you pay it back, I wouldn't be too worried about it. This is my advice as a CPA.
Yeah. So, their question was about that distribution. So I'm guessing by distribution, Mark, you mean is that kind of forgivable? The 100K, the other 100K, not the loan part. It's kind of like the forgivable distribution. I think that's what he's talking about. I don't believe there's any usage restrictions other than, what was there before. Unlike the PPP has a much more strict rules over there. Correct me if I'm wrong, Thomas. I think he's talking about that early distribution versus the loan. This other 100K. Yeah.
I believe that there's no, so on the $100,000 distribution from a retirement plan, there's no early payment, or no early distribution penalty if you're younger than 59 and a half. The other thing to keep in mind, other than that 10% penalty, is that it's still going to be included in your income, as I understand, but it can be included in your income over 3 years. And that's something else. Not a lot of people probably know about the Secures Act that was passed in November, December of last year, but there was a similar distributions that can be taken for having a child, for example. And so, and I think one of the provisions there was that this distribution is still going to be part of your taxable income, but you could do it over 3 years. And so this seems to follow the same rule. And because this is brand new, I don't know how the tax forms are going to look, so I don't know the details. So do you plan to keep it in your income, but you could spread that over 3 years evenly, as I understand?
Interesting. I will definitely follow up with you on the Secure Act, since I did have a child last year. Anyway, kind of get back into the session over here. Looks like we may be running out of time over here. Just want to do a quick time check. I want to kind of get into the planning ideas. Let's kind of go over that, and then maybe touch base a few rules on real estate professional. We'll do a wrap. And raise your hand for listener over here if you want to kind of have even a follow-up session, kind of dig in a little bit deeper with Thomas on real estate professionals, all various different ways to kind of offset the tax over there. Okay, I think we have a few people who are interested in that. So we maybe just plan doing that. Sorry, go ahead, Thomas. Yeah. Okay,
got it. So just to wrap with the 2020 planning ideas, considering everything with the CARES Act and the current situation. So if you in 2018 or also in 2019 had a net operating loss and that was going to be carried forward, and I think most people are aware whether they had a net operating loss or not. Their CPAs usually bring that up. But if you had that for 2018, the first thing I would suggest doing is consider filing that carryback form by June 30th for 2019. You have more time to think about it and to do that. But doing that carryback, that's good. Again, when you file that loss claim carryback, the IRS processes that and they send you a refund for the taxes you paid in that prior year for the amount of that loss that minimized your taxes. Another thing is, even though a lot of taxes have been deferred, there's been all these tax benefits. I'm a little bit nervous for some people that they're not preparing for the July 15th payments. There's 3 different payments that are going to be due for taxes. There's your 2019 taxes if you had an amount owed and you still haven't paid that yet. There's also, if you have to do quarterly tax estimates, that might be for people who don't have just a W-2 job and they have other kinds of income, or even if their W-2 withholdings aren't sufficient to cover their taxes. There's also that 2020 Q1 and 2020 Q2. So that's going to be a lot of taxes for some people to pay all up front. And I know for some clients already, I've talked with them about the amount that they're going to be owing on July 15th for taxes is pretty comparable to what they're getting in these PPP loans. And so there's a huge amount of tax I think that's going to be owed for some clients. So definitely work with your CPA to determine what that amount is and whether you should be using prior year safe harbor for those estimates or using the actual year-to-date income if it's lower than 2019's income was. Another planning idea is for 2020. If your income is low, and you can do this closer to the end of the year, like around November, if income's really low and you're expecting to go back up in later years, consider doing Roth conversions on your IRAs or in-plan Roth conversions for your 401ks. You could do capital gain harvesting. So kind of the reverse of if you had, normally we do capital loss harvesting by the end of the year, where if you had capital losses, we would say sell those so that way you can use those losses to offset your gains. In capital gain harvesting, it's kind of the opposite. If you had a highly appreciated position in your stock, for example, then you might sell part of that so you pay tax either at the 0% long-term capital gains rate, so you'll pay no tax, or you'll pay some at the 15%. And so you're kind of stepping up your basis and minimizing how much tax you'll eventually pay if you're going to liquidate that in the future. And then also for bunching charitable contributions, and I know some people prepay next year's property taxes before the end of the year for all their rentals. So those are a couple things that maybe you don't do this year. You might do that next year. So consider in 2021 paying property taxes for 2020 and 2021, 2022. So now you're bunching up 2 or 3 years worth of donations and deductions, but in 2021. And then if you're expecting a large loss in 2020, so like if you've already got a bunch of losses already and you think there's going to be even more losses and no other income for the rest of the year, then you might talk with your CPA on, well, can I defer any income? How can I maximize that loss? So that way, when you do file your 2020 taxes, you could carry it back and claim that loss against other years. And then lastly, I'd suggest for owners with an S corporation who are required to take out you have to pay yourself a reasonable compensation. I'd suggest reevaluating that. I have a couple clients who business is really slow and they don't have any employees to manage at this time because they're court required to shut down. So they're just working less hours. And if you're not taking out any distributions, working less hours, you're going to have a loss for the year. Those are all factors that might justify either pausing your reasonable compensation or lowering it. So then you're just paying less on the FICA taxes that go along with that reasonable compensation. So those are my 2020 planning ideas.
So really, you're kind of banking on the idea of, hey, this year, most people is probably going to experience somewhat a loss. So like your strategy this year hold up should be kind of maximize that loss on paper or whatnot, and then potentially kind of apply that for future years or, back apply it to the past years. Yeah. Great. Awesome.
Yeah.
Awesome. So we're just going to kind of almost like a teaser over here, but I want to just kind of address the questions. I have a lot of people who comes in and they do passive investments, or I have partners who's doing real estate investing, etc. So for our audience, I think the real estate professional question was always coming up. And then you mentioned before there's some ways, for example, have to kind of go back and reapply the losses as a real estate professional. For me, like this is kind of like the meet up presentation. Unfortunately, we're kind of running out of time. Probably bring you back for another session on this. But just on a high level, can you kind of give us a little bit rundown on real estate professional and then some different ways to kind of be able to take these losses and offset your active incomes?
Yeah. So in like one sentence, how to qualify as a real estate professional and take these losses is you need to meet the hours test for being a real estate professional, which means 750 hours and 50% or more of all your income producing activities time is spent on real estate activities in which you materially participate. Once you meet that real estate professional requirement, then for any activities that you materially participate in, and you can group these activities in a certain way too, there's an election for that, then you can use then those activities which you materially participate in with the grouping, then you can take those losses instead of passive losses as ordinary losses and use that to either offset other income, or if you didn't have any other income to offset, then you could carry that back or carry that forward. So that's real estate professional taking those losses in a nutshell. The details are, it's hard to summarize and simplify that. And I'll just kind of end also with, it's not always in the best interest. I've actually had a couple of clients in the last, as I'm doing these 2019 tax returns, that they had prior year passive activity losses, and qualifying as a real estate professional was not to their best benefit that year. So that way, these passive losses, so that way the passive gains they'll have next year will offset with their prior passive losses from previous years. There's also sometimes as a business owner, you might have a K1 that comes from an operating business, that maybe that's passive income to you. And so maybe, you want passive losses from your real estate. So in a lot of cases, it's great. And in some cases, it's not the best fit for everybody.
Gotcha. So using, again, we're going to tee it up with a few real examples over here. So for example, using my cases, I obviously in the last year, I've worked, I always worked a lot of hours. In 2018, I just elected not to be a real estate professional because I never want to deal with the IRS audit, right? But in 2019, we did look at our hours and income, etc. So have made the decisions to kind of quit my W-2 and qualify as a real estate professional. So in this particular case, kind of going back, tying with the CARES Act, in my particular cases, what I qualified then for also use the loss, because just by the way, for everyone who's background over here, I have large losses from bonus depreciation, cost segregation on paper, not actual losses. And these could go offset my income because I became a real estate professional. Now in 2018, I was not a real estate professional. Then could that loss actually go back and kind of offset that? Should that, like, is it worthwhile to kind of do the amendment?
Yeah. So, so like you said, in 2018, you wouldn't be able to meet the more than 50% of your time was spent on real estate activities test. And so, but in 2019, where you had a W-2 for part of the year, and for the remaining part of the year, you didn't. And even when you did have a W-2, you were working on real estate activities. And so,
Right.
when we look at all your hours for the year, you met the 750 hours test. You also had, you met the 50% of your time test. And those tests were met in activities in which you materially participated in. So in your case, those are both the rentals that you own 100%, and then other activities in which you materially participate in. Now, it would actually be different if you only passively invested in real estate and you did not have any rentals that you owned 100%. So if you only had limited partnership interest in real estate syndications and you were 100% passive and didn't have any other real estate activities that you materially participated in, then it would be a completely different answer. But because you did meet the hours test and a 50% test in these activities, which you have material participation, you qualified as a real estate professional. And then we look at, we're going to group these pass-through losses, not only with the activities you already materially participate in, but we're going to look at the things you passively participated in. We're going to do an election to group all those together, so that way we can look at all your losses from the bonus depreciation and cost segregation. And then we're going to have that go through your 2019 tax return. It's probably going to wipe out all your income. And then for 2019, because we have such a big loss still, we can do that carryback election. And then that's where I don't know for sure. Do we have to go back to the 5th year, 5 years ago, and then carry it forward, or whether we can just go back to 2018? So I don't know which year that's going to apply to, but I think that I'm expecting that we'll be able to carry back your loss.
So even though back then, I guess my question was, even though back then I wasn't a real estate professional, but the losses could actually carry back. Oh, perfect. Yes, then I have W-2 taxes that I can offset. Definitely will be following with you on that. Okay, great. Well, thank you so much, Thomas, for all the questions. Last call for question and answers, and I think we're going to do a wrap over here. And I think I will invite Thomas back, and maybe in a few weeks over here, to kind of really talk about 2020 plan and using some scenarios to kind of vet out, these are some ways to kind of take that. Because I think a couple things I noticed that happened during this downshift is, obviously people lost money in the stock market, in the oil market potentially, right? So I think oil is also something very interested that I'm kind of diving into, looking at some of the tax savings on oil investments, and also real estate investments for sure, and how we can kind of strategize that for 2020s. Again, it's a year kind of harvesting the losses on paper losses, and then potentially kind of have a good idea of how 2020 tax year look like. And again, we can kind of dive into a little bit more scenario question. Now, do me a favor for the listener over here, send me any scenario, your questions ahead of time, so we can kind of get that session like more towards the scenario, like specific examples that you have, etc. All right, I don't have any other questions over here on the Q&A. Thank you so much, Thomas, for joining me today and giving us your precious hour, a little bit over time, an hour and 15 minutes here. And the recording will be ready, and it will be sent out to you guys. And hopefully, we can get the second session started planning in a month or so here. Yeah, great. Thank you so much, everyone, for your time.
Thanks, Lisa.
Thank you. Bye.